Hello, um, welcome back. Now, this is video number 22. Um, and Now, in this video, let's think about the downside or pitfalls of the price earnings ratio analysis. Um, First of all, because price earnings ratio is based on the basically financial statements, and the financial statements basically heavily dependent on the accounting practices, right? First of all, when they there's a uh, and I mentioned this before, right? Also, that there is, a difference between accounting earnings and economic earnings. And because it's financial statements, it's all by, accounting, it's all, accounting earnings. And one thing about accounting earnings is that it doesn't, and it doesn't reflect the uh, inflation. In other words, the earnings in the accounting, in the financial statements, is not adjusted for inflation, and that causes some, um, issues, discrepancy in price earnings ratio measurement of price earnings ratio. First of all, arbitrary accounting rules, such as the use of historical cost in depreciation and inventory valuation, leads to or results in not using inflation adjusted cost. Well, this is now in macroeconomics context. Remember, pi is the symbol for inflation. Of course, in microeconomics context, pi is the symbol for profit. But think about it. In accounting, you just the data collected is basically, nominal data. You don't necessarily make adjustment for inflation. In other words, it's not the real price or revenue in terms of, real revenue, right? Or etc. That's something, quite understandable, in accounting practice, right? And then think about it. If you do not adjust if you do not adjust cost by, for inflation, then uh, the resulting EBIT would be, greater than the true EBIT. Let's take a look at the example to fully understand what, I'm talking about. So in times of high inflation, historical cost depreciation and inventory valuation, not using inflation adjusted cost, underrepresent true economic value. Now think about it. Depreciation and cost of goods sold, right? Depreciation and, direct cost would be less than true depreciation and cost of goods. Think about it. Adjusting for inflation, right? Depreciation and the cost should be, greater because of the because of inflation. Everything is more. Think about it. everything is more expensive, when there is inflation. A bottle of water, which used to cost, $1, would be, uh, $1.10 if there is 10% inflation. But not using inflation adjusted cost, right? Especially in case of depreciation, right? Using the historical cost, and just uh, using straight line depreciation. Everything was straight line depreciation. Simply uh, uses the purchase cost of the asset at the purchase point. So depreciation uh, is simply, based on the old depreciation, annual depreciation amount, right? Old depreciation expense, right? And then it understates, right, the cost, and therefore EBIT, it results in higher EBIT than uh, true EBIT. So then P ratio would go down. P ratio, higher EBIT, right? Higher earnings than true earnings will, lower the P ratio. And therefore, the P ratios fell dramatically in the 1970s when the inflation spiked. 1970s, was a decade, notorious for uh, stagflation. It's high inflation with uh, uh, happening together with economic stagnation, and it was coupled with uh, the oil crisis due to there were three Middle East wars during the 1970s, and it was really 1975, 76. Oil prices were crazy. Oil prices, skyrocketed. So basically, it's called, um, supply shock. The cost side suffered. In other words, uh, the supply side suffered a lot due to oil price, uh, skyrocketing oil price, and that causes supply side to shrink. Okay, and think about it, because oil is the underlying element in everything, right? It's not just transportation and heating. Um, First of all, electricity is generated, right? And once oil price goes up, uh, the, it costs more to generate power, right? Electricity, utility bill goes up. As utility bill goes up, um, the cost of running the plant goes up. So cost of everything goes up, right? And that was the what stagnated the economy. Uh, and also due to high oil prices, every price of everything is higher, right? So inflation, right? Yeah. So that is why it showed this pattern. Now the red curve is the inflation, right? Blue blue curve is the P ratio, and during this decade, right? Uh, it may not be the entire decade, but since around like 1973, right, until 1980, right? The inflation was high, almost, like 10, 11, 12% inflation, whereas P ratio dipped below, average, P ratio, like, normally the P ratio would be around 20. I mean, historical average, until, 1990s, I would say. Uh, Historical average P ratio for S&P 500 was about 20, and then during this 1970s, it even went down to like 10, right? And then 2010, look at the P ratio, all this, and 2000 around uh, and since like 1995 and early 2000, P ratio went up to 30, and then even around 2009, 2010, even 50. This is crazy, huh? Very high P ratio by historical standards. Now, and then what are the other pitfalls? And then other pitfall. Another pitfall is the earnings management. It's the practice of using flexibility in accounting rules to improve apparent profitability of the firm. And also reporting pro forma or operating earnings. In other words, not the they are not reporting net profit or EAT. They are reporting EAT. Initially they report operating profit, right? EBIT. And operating profit is always greater than EAT, right? But once, who knows? I mean, a company that looks very profitable, right, by EBIT, maybe obligated to pay huge interest. And if that's the case, after and then taxes, right? The resulting EAT may be, just insignificant, right? Or also companies, using gross profit or gross margin. And I've been telling you this: gross profit, or gross margin. What's gross profit? It's just subtracting only direct cost, or subtracting only CGS from the revenue. And obviously that cannot do the justice, because anyway, at least to arrive at EBIT, you have to subtract both um, direct cost and indirect cost. Direct cost meaning CGS, cost of goods sold, and indirect cost, OPEX, operating expenses. But gross profit is before subtracting operating expenses. So it's quite obvious that it cannot be, right, true measure of their profitability. But a lot of companies, so this is wrong. This is wrong, right? Using gross profit as a initial measure. In accounting, they tell you gross profit is the initial measure of profitability. Yes, true, it's initial measure, but it's not the ultimate profit, right? A company that looks very profitable at gross profit level may not be profitable at all after subtracting expenses, right? If you subtract OPEX from gross profit, then the result is EBIT, right? And you know, so what should I do? This means, this is not a good thing, right? Looks like, times. Let me erase that. Anyway, the point then is not, oops, why isn't it showing? And then, and it's called pro forma, statement, and it ignores, restructuring charges, stock option expenses, or write down of assets from continuing operations, et cetera, et cetera. Now, has anybody heard of Sarbanes-Oxley Act 2002, right? Sarbanes-Oxley 2002. Now, in the history of the financial market, right? Um, I'm not very keen to institutional, side of the finance, but at least there are three important legislations that affected three important legislations that really had a big impact on the financial market. The first one is, Glass-Steagall Act. Glass-Steagall. You may have heard of it. And Glass-Steagall is 1930 something. Glass-Steagall Act came out as a result of 1926 stock market crash, and the resulting, ensuing depression, Great Depression, right? Now, Glass-Steagall Act basically prohibits merge. Desegregation sounds weird, but separation. It bans the merger between investment banking and commercial banking. Okay, so in other words, it separates the investment banking from commercial banking, and all that chaos, all that financial crisis in 1929, the Great Depression, was all started by the fact that there was no clear line drawn between investment banking and commercial banking, and all the banks commercial banks were getting into the investment banking, and they were taking a lot of risk, and that it happened. And but Glass-Steagall was actually repealed, towards the end of Clinton administration. And then after Bill, the law was repealed. Glass-Steagall was repealed, and what happened in 2008 financial crisis, and all the same, the repeat, you relent, or you relent, or release the leash on the financial market, the regulation on the financial market, then they always, they end up, crisis. They always end, because of that. Financial market is prone to be end up in moral hazard. They will be reckless, and then by, there will be a huge, moral hazard, and then um, eventually end up in a disaster like that. And it repeated, right? 2008, after repeal of, about, 10 years, after repeal of, Glass-Steagall Act, then it happened. In 2002, so came out, I mean, this is not exactly the result of the, uh, because financial crisis, 2008, because it preceded financial crisis, but it's about accounting principles, right? Uh, 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 in other words, um, it's a strict control over laxity, relaxed, accounting uh, practices, because they bend the rules a lot. So it's called, Sarbanes-Oxley, Sarbox, or sometimes SOX, Sarbanes-Oxley. And then the third one is, that's number one, right? Glass-Steagall. And Sarbanes-Oxley is number two. Number three is Dodd-Frank. Dodd-Frank Act, Dodd-Frank. And this came out in 2008. So, and this direct result of the financial crisis in 2008. So this, but at least, I mean, even if I'm not really interested in my my expertise is not in the institutional side of the financial market, but at least, these three legislations, you should be, at least you don't, even if you don't know them thoroughly, at least you should have heard of them, right? If you're a finance major. And Sarbanes-Oxley is about the accounting uh, practice. Dodd-Frank is about the, restraining um, the restraining the uh, what's the word just escapes me, uh, to haywire, the liberal or haywire practices of the financial market, right? Basically, risky behaviors at the expense of the uh, the clients. The clients, basically, uh, average, financial consumers, right? Yeah. So, so uh, also, those accounting practices have a lot of, impact on P ratio. In other words, uh, they can manage their financial statements, or cook the book, and then, to favorably, right, uh, to affect the P ratio favorably, right? Now, also, price earnings ratio is related to the business cycle, and basically, in dividend discount model, we are, uh, uh, we use, economic, I mean, account. accounting earnings, in general, because the data is generally, easier to get. But if possible, we should use, economic earnings, which is net of depreciation. So it's the maximum cash that the firms can pay out without depleting productive capacity. Okay. And of course, GAAP, generally accepted accounting principle. GAAP uses, accounting earnings, not economic. Now, however, normal or justified P/E ratio assumes earnings increase at a constant rate or on a smooth trend line. In contrast, reported earnings can fluctuate around the trend line over the course of business cycle. Yes. Generally, P/E ratio is based on the earnings forecast, right? Based on a constant growth rate. Of course, how else, you have seen so far, all those, models eventually will come to golden growth model, and golden growth model assumes, constant growth rate, right? So that's what makes the P ratio deviate from reality. And price earnings ratio reported is actually not P. Think about it. I've been telling you over and over, right? What is when we calculate P0, the formula is, right, always, one next period earnings, right? Earnings at EPS, right? Earnings per share at time 1 times 1 minus plowback ratio, right? Over Q minus G, right? So in other words, price earnings ratio should be P0 over earnings per share at time 1. But in reality, they just simply use this. They simply use this, P0 over E0, because data is readily available, right? So obviously you can't get the correct P ratio, right? It doesn't give you a correct P ratio, and it will differ considerably from future economic earnings. It's current accounting earnings. So this is what, when earnings are temporarily depressed, P ratio should be high. Of course, it's simply due to mathematical construct, right? If this is, depressed, I mean, especially in reality, they use this. If earnings, if denominator goes down, the whole fraction goes up. The whole fraction, right? The denominator of the ratio responds more sensitively to the business cycle, right? Earnings, of course, responds more sensitively to business cycle. Right? In other words, earnings, right? Then the numerator. And this pattern is borne out well, in this example. Taking a look at these two companies. One is Intel. The blue is Intel, and the red one is Con Edison. And we all understand Con Edison is utility, right? Con Edison is a utility company, right? Intel is, IT, right? And Intel's growth rate is, 10.3%. Con Ed growth rate is only 1.2%, almost 10 times. And look at the if we set earnings per share 1995, right, at 1, starting from there, right, they were both at 1 in 1995, and then over time what happens, Intel is riskier company. It's one thing, a couple of things you can tell from this graph. Intel is riskier. It grows at a fast rate, but riskier. Con Edison hardly grows at a very slow rate, but the P rate, therefore P ratio is low. Mature company, right? But it is less risky, way less risky than Intel. And this straight line is basically smoothing of, linear approximation of Intel. Okay, this is linear smoothing, right? What should I? Of Intel, right? Okay. And then, so that's what I was saying. But I will have to continue with this discussion in the next video, because it's been more than 30 minutes. I think 35 minutes. So I will have to stop the video and continue in the next video. All righty. Thank you for watching. Signing off.